Happy New Year. Going to talk about the Texas Department of Housing and Community Affairs Mortgage Credit Certificate, designed to help first-time homebuyers by allowing you to take a portion of the annual mortgage interest that you pay for the home that you buy to help you lower your overall cost of ownership. Let's get into it. The Texas Department of Community Housing Mortgage Credit Certificate is a tax credit. Your state may also offer a mortgage credit certificate. Your city may even offer one, or your county. So stay locked in. Don't get lost in the fact that I'm specifically speaking about Texas, because they're across the country. And these are tools that you want to use. Again, they help you as a first time home buyer, meaning you've not had ownership interest in a primary residence in the most recent 3 years, and will verify that with your tax returns and transcripts for the most recent 3 years. For 2025, we're going to use 21, 22, and 23 tax years up until February 15th here in the state of Texas. It might vary where you are, but it's a tax credit. You're able to take in this program up to 20% of the interest that you're going to pay annually. And so that's not to be confused with the mortgage deduction. But the thing with the mortgage deduction nowadays is this: because of the higher standard deductions that most people get on their tax returns, there's really not a lot of itemization going on anymore. But that's where the beauty of this mortgage credit certificate comes in, because it's actually a credit, a dollar for dollar credit if you owe federal taxes. So before we go to the next slide, that's another caveat that you have to understand. If you're someone that does not file tax returns, federal tax returns, because your income is not taxable, and there's several different scenarios: Social Security, retirement, pension, maybe you're a disabled veteran or something of that nature, this may not be the option for you. But more times than not, this specific program, I'm dealing with teachers, firefighters, everyday Texas heroes like yourself that are paying federal taxes. And so that's the beauty of this, is because even if you don't get to itemize, deduct, or have enough deductions to itemize, pardon me, you still can use this as a credit dollar for the federal taxes that you owe. So now, how much of that interest that you're paying can you deduct on an annual basis? Excellent question. And it's 20%. 20% of the annual interest that you're paying. Here a little later, we'll give an example just to give you a visual. If you're like me, I like to see things visual. I learn visually. And so we'll have an example for you. But here's the deal. Because the tax credit in this particular case, the Texas Department of Housing and Community Affairs mortgage credit certificate, is at 20%, well, then there's no ceiling with that amount of money that you can use as a dollar for dollar credit to pay your federal taxes. So you might be doing some research and you might notice that where you are, or different programs have a higher percentage, higher than 20% on a mortgage credit certificate. And every time you see those things, there's going to be a cap on the credit that you can use annually, and it's typically $2,000. So anytime you see a mortgage credit certificate with a 20% credit amount, then typically there's not going to be a cap on that credit amount that you can use. If it exceeds 20%, then more times than not, what you're going to see is a cap, and it's typically no more than $2,000 a year. So as we move forward, we want to look at the eligibility. In this particular case, the eligibility is you got to have a minimum credit score of a 620, right? And you must be a first-time home buyer. As we stated earlier, we'll state again, that's anyone who has not had ownership interest in a primary residence for the most recent 3 years, to be verified or validated by your W-2s and your tax transcripts. Okay, so at the time of the recording of this video, 1st of January, I think it's the 8th day of January, we are looking at years 21, 22, and 23. And what we're looking for is to make sure that you've not benefited from any type of revenue bond in the past, number one. And then number two, that you don't have any type of mortgage interest, which would validate that you are a first-time home buyer. There are some caveats to that in which you may have ownership interest. And if that's the case, and if you feel like you don't meet the first time home buyer requirement because it wasn't your primary residence, that's something that you and the lender that you know, like, and trust could look into, because there might be a way for you to still be counted or qualified as a first time home buyer. Let's move on. So, limits. Typically, there are no limits with a mortgage credit certificate if it's offered in a standalone version. At the time of the recording of this video, this program no longer offers the standalone option, which was great, by the way. But again, where you are, that might be an option. If it is, you want to get it. You want to get it because, again, it's a credit that you can use as long as that home is your primary residence and as long as interest is being paid. Okay. So with that being said, with this program, there are income limits because you have to couple it with the My First Texas Home down payment assistance program and the mortgage credit certificate. And that version or that aspect of the program does have income and purchase price limits, but they're very generous. And a lot of you guys would be surprised how generous they are. And I say that because in the example that I'm going to show here in a minute, I'm using a $450,000 purchase, and a lot of realtors, a lot of sellers, and a lot of buyers have a negative connotation when we talk about down payment assistance. But I'm here to tell you that there are more folks that are making over 100 grand that are using these programs. They're savvy, they're taking advantage of them. And so I don't want you to think that it's a negative thing if you are positioning you and your family to benefit from OPM, right? Other people's money, as long as the strategy makes sense, okay? So income limits, there's purchase price limits, and then home types, your standard home types, your single family residence, homes that are in planned unit developments, condos, townhomes, right? We may even be able to get a manufactured home approved for you with this program. But again, the lender that you know, like, and trust should be able to guide you in your specific situation on if that's applicable. It's got to be your primary residence, okay? This is not for investment properties. And the deal is this: if you move after the first year, because a lot of you guys want to be investors, get it, right? But if you move, then you're going to lose the mortgage credit certificate because it has to be your primary residence. Let's think about it. The spirit of this revenue bond is to help people become homeowners. If you want to be an investor, not mad at you, but you have to understand the program, right? And so again, you want to really sit down and strategize with your lender of choice. It's hopefully someone you build a relationship with so that you're not all over the board when you're trying to move forward. But don't shoot yourself in the foot. Again, this is for primary residence homes. It has to be your primary residence. And as soon as the home stops being your primary residence, well, then you're going to lose the benefit. Let's move forward. The benefit duration. So there's some misunderstanding as it pertains to this program, the Texas Department of Housing and Community Affairs Mortgage Credit Certificate. As long as you live in the house as your primary residence and there's interest that you're paying federally and you have federal income taxes that you're paying, then there's no end to the program. So it's the gift that keeps on giving year after year. And as you pay your mortgage down, obviously the interest declines over time. But again, it's still a great benefit. So with these, there's no 5 or 10-year cap. As long as it's your primary residence, you're good to go. As I stated earlier, now at the time of this video, if it changes, I'll let you guys know. But there's no standalone. So with this program, you have to do it in combination with the My First Home Texas down payment assistance, where it actually offers 2, 3, 4, 5% if it's available, a down payment assistance component that the program dictates what the interest rate is. Okay. But if you're a first-time home buyer, again, in the example that I'll show you here in a minute, I'm going to bring up a term called the effective rate. And if you understand the effective rate and how I'm trying to explain it to you, you'll understand that a lot of these interest rates that you're seeing are not as bad as they are because of the credit. But before we move forward, you must use it in combination with the down payment assistance program, specifically the My First Texas Home. If you want to know more about that program, you can watch this video right here. Let's move forward. So there are some special provisions. You can't see the title here as we end up, but there's special provisions for veterans or folks that are qualified as a veteran, okay, honorably discharged as evidenced by DD 214, and you've not previously used any type of mortgage finance revenue bond, then you don't have to be a first-time home buyer. That's one of the special provisions that you could get around if that's applicable to you. Number two, if you're buying in a targeted area, what's a targeted area? That's an area in which the house sits in a census tract where 70 or more of the families in that area have an income that's at 80% or less of the area median income. So if you're a qualified veteran, you don't have to be a first-time home buyer. If you're buying a home in a targeted area, you don't have to be a first-time home buyer either. And the income and purchase price limits are higher in those areas as well. Now, the one thing that I do want to bring your attention to is there might be what's called a recapture tax, but in all my years of doing this, I have not seen someone meet the recapture tax requirement because three things have to happen, all three. And just to summarize, your income has to increase 5% every year, starting from wherever the income was when you qualified. That kills most people, right? Most folks haven't got a raise in 20 years. You have to sell and make a profit, right? And so I'm gonna have another video next week. We'll go over recapture tax, going into a little more in depth, but I do want you to be aware. So there you have it, man. That's this week's down payment assistance program, the mortgage credit certificate. It's the gift that keeps on giving. It's a tax credit. And oh, you know what? I'm getting a little ahead of myself. I did tell you guys I was going to give an example. So for those of you that stayed around, here's the example so you can see this credit in operation. Let's check it out. So as you can see here on the screen, the mortgage credit certificate is at a 20% participation. Okay. And so the example that we had earlier, yesterday, example that I did yesterday for a client, the sales price was $450,000. Okay. This is an FHA loan. Let me put that here. Okay. And so the total loan amount is going to be $441,849. This is important because the combination, the down payment assistance portion that I mentioned earlier, that you have to use the MCC with now with this program, down payment assistance based upon 2, 3, 4, or 5% if they are available on that given day, but it's based on the total loan amount. Okay. So this client went with the 4% down payment assistance, which when you do the math, that's a total of $17,674. That's the down payment assistance amount. Just off of the strength of FHA and the minimum 3.5% down payment, okay, that equals $15,750. So knowing that and understanding the admin fees that are associated with this program, just to give you full disclosure, the client is going to get a assistance of $16,804. So right there, that's already more than what the down payment would be. Okay. But that's not really the gist of what we're talking about. The gist of what we're talking about is the credit. So the interest rate on this down payment assistance program is 7.35%. And that's where most of you guys get lost. You get lost in the sauce. But because of the 20% that you're able to write off essence or take the tax credit of up to that amount every year, the effective rate of this loan is actually 5.9%. And you might ask, well, how are you coming up with that number? Because I'll just use the first year. In the first year, okay, when you take 7.35% and multiply it times the beginning loan amount, In that first year, it's 30 something thousand in interest that will be paid, but 20% of that is $6,512. Now, this couple, I did the math for 2024 tax bracket. They're married, okay? And with the income that they were making, roughly they'll owe about $10,527, I believe. $10,527. That's ugly. Let's do that again. Let's take that off. Okay. So they're roughly going to owe $10,527. Well, the first year, and here's the deal, this is a credit. The first year in this loan, they can take $6,512, that credit, and apply it towards this federal tax bill, because that's what they owe regardless. Now, most of you all, because the way you set up your withholdings and things of that nature, a lot of you guys are getting money back. Okay. So what happens is, if you're getting money back already and you're paying federal taxes, well, this 6512, if you owe this 10, that whole 6512 goes towards this balance. And so if you have over that, because you might have children and things of that nature, that just increases the amount of money that you get back on that return. And so now you're actually using other people's monies, right, via the tax credit, and not just getting a refund of the monies that you lent to the government too much throughout the year. So there's a myriad of things that you can do with these monies. You can use it to accelerate the principal pay down on the home. You can use it to invest, put the money in other places and have it grow. There's a lot of things that you could do. The point is, this tax credit and the rate environment that we're in, it makes sense. And this really makes home ownership more affordable, and it helps you get on the property ladder. And when done right, gives you a lot of options that you can use to benefit your family as far as growing your wealth. So that is the example. Again, don't want to keep you too long. If you need help, reach out to us. We'd love to have a conversation to see if it's a fit. But if not, take this information, empower yourself, and speak with the lender that you know, like, and trust, and make sure you're getting this tool as a first-time home buyer, because that's the only time you can get it. So there you have it. Next time, we're going to be talking about the recapture tax. So subscribe to the channel so you don't miss it. And if you have any questions, comments, or concerns, or you want to reach out, check out the description. You guys be blessed. We'll talk to you soon. Peace.